All right. Good evening, everybody. Once again, welcome to our next session in the series of topics we have for comprehensive financial planning, which we are doing in collaboration with Samasti. And today's topic is life, disability, and long-term care. One of the very dear topics to me for quite a number of reasons, which I will explain very shortly. So this is what we have been doing till date. Okay, so this is me for those of you who are joining new. Others may be already familiar with me. My name is Chandrasekhar Azad. I live in San Ramon. I have a background of insurance, IT, real estate, and investments and all. And currently, I am very passionate about doing this particular session, this particular field, rather, educating people, sharing the knowledge, emphasizing the importance of comprehensive financial planning. Today's topic, this is. Now, before we go in depth into the our topic, a disclaimer is in order. Whatever that we are doing today, and in fact in this series of sessions, is an attempt to share and have an open discussion with a large number of audience, trying to educate them at different aspects of financial planning, whether it be it investments, insurance, risk control, college planning, estate planning, whatever. So based on this generic presentation, you are not expected and you should not take any action. If you need to take any action, please sit with me or sit with your financial advisor and then do some that is specific to you. Now, when I say comprehensive financial planning, that encompasses multiple areas. Multiple areas being estate planning, protection for life and asset and long-term care, retirement planning, college planning, how to fund kids' college education, and taxes are a huge issue. And how do we save on taxes, especially going forward? It's going to be huge because we are accumulating so much of internal debt. And how do we control the risk and how do we ensure better return on all our investments? Estate planning, again, we had a very in-depth session, 1.5-hour session. Hope most of you have attended. So in these topics, a lot of things, 7 topics were already covered. Today, we are going to focus on life, disability, and long-term care. Now, long-term care, we call it a ticking time bomb because a lot of us are not aware, absolutely have not done anything about it, and it is into the distant future. So that is why it is out of sight. Unless somebody shows you or someone close to you or you yourself experienced firsthand, you have no idea what it means. Not just financially, emotionally, or in every way. It is not just for one person, but it's for the entire family. So that's where today's topic is really close to my heart. I thought I have done everything right in the we have come here in a very senior position and we did very reasonably good until something very at a personal home front hit. My parents live with me. In fact, my dad used to. 2.5 years back, from downstairs, mom screams and we go, and there my dad had a stroke, serious stroke. Entire his left side was paralyzed. For what followed next 2.5 years has been a very, very trying time, to say the least. Not just financially, in fact, financially we were kind of blessed in a different way, but emotionally or otherwise. So it is a journey that hopefully most of us will not have to go through. But if something is there like that in our path, it's a huge risk, it's a landmine, it's a ticking time bomb that we need to address. And if we plan better, probably we can avoid it, we can circumvent it, we have a bridge or whatever, we can diffuse it, all those things. So that is what we are going to cover today. Now, before we go into in-depth long-term care and how to plan for and how to take care of it, a few things before that are in order. life insurance per se. Most of us are aware, but unfortunately, many of us are not doing enough on that. We have no issue in paying $3,000 a car insurance because we see the shiny new car or the government mandates that you better have the liability insurance. So we are forced to, we automatically pay. We don't even question for a second. Whereas when it comes to protecting one's own life, thinking about family, we tend to rather absolutely ignorant or overconfident. Either way, we are not doing the right thing. Time and again, I'm very well experienced people, senior people, people who are doing very well in their fields with good amount of wealth that was built, to my horror, are very underprotected. I keep getting this, you must be seeing this particular, what do you call, small screenshot, a GoFund message, which just came last week, in fact, 5 days back. The first thing I do is, it's a sad thing. It's a horrible situation for a family to go through. But what is worse is that they have to go out to the world, to the strangers, and hope that people will pitch in and help them, support them. This particular episode, the daughter wrote a very passionate and heart-rending appeal, and I was not just doing whatever my part, but also shared that in various forums. People are very kind, very generous, and her target of 200K was met within 3-4 days. But I have a problem with that. All of us, especially who are present here, we have means to, and we have knowledge, we have everything to do the right thing. Why do we need to depend on the generosity of strangers? Why can't we do the right thing so that our families don't have to go through? Their lifestyle is protected. The whatever little wealth that is there, that is taken care, that is protected. The kids' college education is not, what do you call, on the line because suddenly some tragedy happens, right? So we need to do the right thing. And most of the time when we are young, it is like pennies on the dollar. It's like a pre-IPO stock. I keep saying that, unlike buying Amazon at 3,500, it's like buying Amazon in 1990s, late 90s, at pennies on the dollar. So when you are young, that is how the risk is, pennies on the dollar rather than very expensive. So please, all of you who are present here, ensure that you take care. What is the shortest, best way to? It is about 10 to 15 times is what, depending on your age, depending on what kind of annual income you make. That is a broad guideline. One has to have the bare minimum of that in order to protect. Now, coming to accidental death, disability, almost all companies have these benefits. And to my horror, people are not paying attention and leaving them at a bare minimum, whatever is given by the company, 1 times the annual compensation in case of life, and 25,000, 50,000, whatever is in case of AD&D. Please pay attention when your annual enrollment comes in, and whatever is the maximum supplemental benefit that is available, especially if you are a little bit into late 30s, 40s, 50s, you take care of. Very young people, you have to take the benefit of that, but you also have to actually, outside, by delinking from the employment, you protect yourself for 30 or 35 years. Typically, a 30-year-old male or female for $1 million for 30 or 35 years costs about $400 to $500. That is nothing. Absolutely not even what do you call, $1.50 or $2 per day, right? So why is that we don't do it? Mostly I'll say because we are ignorant, or sometimes we are a little too confident, nothing will happen to me, until I point out to these GoFund messages. Absolute young families. Just 6 months back, an young family in Frisco, Texas, they were going to their brand new home within a mile distance from their rental property. Serious accident, 8-year-old daughter remained. Both the couple with adult friend passed away. So I can't overemphasize on this too. Then long-term disability. Most companies automatically give this long-term disability. So if you are one of those companies lucky enough, whether it is 60%, 66.6%, 70%, 50%, check it out with your benefits. If you don't know, call up your benefits department, HR department, find out that. A few companies offer a choice there. What is the choice? If they're giving, good companies, that a choice of post-tax dollars benefit. If at all your company offers that, please ensure to opt for that. Why? Instead of paying about $20, you may be paying $20 to $15, you may be paying $18 per pay cycle. But when if at all it happens, insurance, personal insurances, especially like this, you should never hope to use them, because that means you are doing well, you are hale and hearty, nothing wrong. But God forbid something goes wrong. At that point in time, you are saved from all the taxation. You basically get post-tax dollars. Very few companies offer. Verizon is one of them, I know, because I was there with, and the city of San Francisco was there. But most of your, if your company offers or not, you check it out. If it is there, please opt for that. Now, the most important topic, today's topic, long-term care. Okay. So I would really like to show this particular, what do you call, Leela Prasad, can you confirm whether you hear the sound?
No.
Okay, 1 second.
Yeah.
I don't think anyone is prepared for a diagnosis, irrespective of the disease, whether it's cancer, whether it's vascular dementia, whether it's stroke, you name it. The diagnosis hits you and you say, now what do I do? My husband was 57. He was a physician researcher at NIH. He was young, he was fit, he was smart, and we ended up with the diagnosis of Alzheimer's, and we were lost in the diagnosis. Life just started crashing down around us. We were not prepared for that, and my husband had no long-term care insurance. What it did was force both of us to leave the workforce. We had disability insurance, we had life insurance, we were protecting each other, and none of it mattered, because the aftershock was a straight financial bleed because of care. What people have to understand about Alzheimer's disease specifically is that it's not a normal part of aging. It's a disease, and the behaviors are extreme. So the caregiver is really the keeper of the secret. You protect a loved one's dignity. No one knew in the early stages that I bathed, shaved, and dressed my husband. But then over time, it becomes more and more challenging. I have two policies to cover myself now, because I don't want my son doing for me what I'm doing for my husband. I don't want to be remembered that way. I'm fearless now. This disease has made me fearless. And the pain that all caregivers suffer, you can flip the pain. And that's why I'm such an advocate. I'm going to fight it, and I'm going to fight it big and with everybody who will join us. That makes me feel better about a very painful situation.
That is really an emotional this thing. In fact, I and my family have gone through personally what kind of emotional stuff it is. It is really hard to take care of a loved one in a stage where they cannot take care of themselves. It's really hard. But add to that the financial aspect of it, it can be terrible for families. So I just can't emphasize, or I can't emphasize more than this, that every family has to take care of this. In fact, it is a must that if you love yourself, if you love your family, if you love your kids, we need to plan ahead. And it is not that something will happen. It is that you are ready if something happens. That is what it is. So this is what we are going to see today. What is LTC and what kind of costs that are involved, why people have to buy it, what kinds of care that are available in the long-term care, and who pays for it, and what kind of different payout options that are there, and what kind of different programs are there. That's what we'll be seeing very quickly. We have a lot of stuff to cover. Now, why long-term care insurance? First of all, we already saw that that is more than enough, but one needs to, let's recap, summarize. Health insurance, it does not cover long-term care. It covers medical expenses when we are sick but not long-term care. I'll explain what that means. Life insurance, it covers our final expenses. It covers all the liabilities, mortgage, and any liability that we may have. It covers any taxes, whether it is estate, otherwise we owe. And most importantly, it's a legacy. It's a transfer of wealth to our kids and the beneficiaries, the near and dear ones. Now, long-term care is what covers long-term care expenses. What do I mean by that? What is long-term care? We'll see that. Right now, right here, this is what it is. What is long-term care? It can be any of these. It's chronic illness or injury where it's not getting better, basically. And we have these 6 different daily activities that we perform every day when we are self-sufficient, we are taking care of ourselves. What are they? Bathing, dressing, eating, toileting, transferring, continence, ability to control. If we are not able to perform any of the 2 daily activities, then someone else needs to take care of us. That can be our family members or some outside help, whether adult care or nursing home, any of them. So then we are in need of long-term care. Any 2 activities, remember that. Now, cognitive impairment like Alzheimer's, basically that means we are not able to take care of ourselves because we don't know what we are, we don't remember anything. And that's where people automatically get qualified for long-term care if there's a cognitive impairment. Now, why is that? Why do we need LTC, long-term care? Most Americans underestimate the risk of developing disability and needing long-term care services and supports. It is estimated that half of Americans turning 65 today will develop a serious disability, serious enough to require long-term care. Now, this is one more different chart which shows that basically 40% of people, 40%, 16 years to 64 years will require some kind somewhere. And 60% who are below 18 years or above 64 years are the long-term care recipients. So basically, who are the people who are receiving? This is the bifurcation. This is the distribution. Now, what are the chances of anybody needing a long-term care? Again, some more numbers from there. 60% of people who may need long-term care are 65 years or older, 40% are in that age group which we saw. Among 22.4 million families in the United States, nearly 1/4 of all the households are providing some kind of long-term care for elderly relatives, about a quarter of 22.4 million families. That means it is not all that unheard of. People are taking care of the senior family members who are in need of it automatically, already they're doing. By 2030, when the last of the baby boomers are retiring, the number of people aged 65 and older will have doubled to 70 million people. So automatically, one thing we all have to remember is this: technology, medical, especially medical field advancements are amazing. We are living longer and longer, not necessarily living a quality life longer and longer with a bit of seriousness, discipline, and all, we will be able to live a longer, healthier life, no doubt about it. But at the same time, the longevity itself is automatically necessitating the long-term care need. So that is a reality. When in olden days, when something goes wrong, whether it is a heart attack, whether it is any of the serious diseases, people used to pass away very quickly because medical field advancements are not so great. Today, we rush to ER, then we are resuscitated, and we are brought back, and we are on tubes, we are there, we are. So that a lot of people say, if that situation comes, I will go away, I will not. It is not in our hands, unfortunately. Life is not in our hands whether to give up. So it is, we will be victims of the circumstances. So the bottom line is, that's a reality. All we can hope is with good health, good discipline, we will fall dead when the time comes, rather go into that. That is the wish. That's one of the best wishes we can wish for, but it is not in our control. That's why we need to do all the planning that we need to do. Now, what kind of emotional aspect of it we already saw, we'll see some more, but what kind of costs that are involved in this? The costs of long-term care are staggering right today, and they are one of the fastest growing expenses of any category. Living expenses, actually food and all is very cheap. In fact, the cost of inflation on the food items is very, very less. But what are the couple of things which are very, very expensive? Mortgage, basically housing is expensive, but inflation is not too much there. Student education and healthcare costs are one of the very highest inflation that we have. Now, in 2008, this is the national average, roughly about 76,000 per annum, costing about $500,000 for over 6 years. Okay, in 2028, that time it was estimated that it will go to 200,000 per annum, about 1.2 million, 6 years. Why 6 years? Statistics show that people who end up in the long-term care, or people who need long-term care, normally the distribution is anywhere from 2 to 7 years. So 6 years is some kind of somewhere there, a little on the higher side of 7 spectrum. But that is the 6 years is the magic number a lot of people advise that we should plan for. Now, 2008 LTC cost survey for California. This is what it was showing in 2008, about 12 years back. 100,000 was in San Francisco, Oakland 92, Sacramento 92, San Jose 89, Los Angeles 76. Now, do you guys want to know how much it is going to cost today, how much it is, and what kind of rate inflation it is going on? Here it is. Today in Bay Area, 2019, the annual cost has gone up to 155K. That is, you see this corner lot bottom, this is a private room. Remember one thing, all the people who will be essentially afford, they want long-term care, they can afford, are the people who are well-to-do. You are used to certain baby boomers, you are used to certain lifestyle. You cannot be in a general ward kind of situation where you are not, you're part of a big, large number. You're not getting one-to-one, you're not getting that special treatment and all. You want that because you live your life like that. So in the private room, nursing care is 155K today. Now, in 2019 to 2029, in 10 years, it's going to go up about 208K. In 2039, it's going to 280K. In 249, in about 30 years' time, most people will be requiring that, who are present here probably, will be 376. So you see the kind of inflation that is there, long-term care. It is estimated anywhere from 6.5 to 10% is the cost of inflation of long-term care. Now, the need for long-term care protection. What are the odds of a major car accident? That is ordered. Residential fire, And car accident, what do you call, admitted into critical care unit also is there. And essentially the bottom one, this 630 out of 970%, some kind of medical long-term care in one's lifetime. Sorry. So American Association for Long-Term Care points out two major, what do you call, causes for long-term care, that is Alzheimer's and cancer. Of course, there are others like what I pointed out in case of my dad, a stroke. So majority of the cases is on account of Alzheimer's and cancer. Types of what kind of care one can hope to get, or what kinds of care that is there. Initially, very early stages, whether it's a cognitive impairment or otherwise, slowly it starts at home. Early cognitive impairment, people need some help, support from family members, be it spouse or children or whatever, bathing, dressing, transferring. And then if it is getting a little tougher on the family, you got to go and work and you cannot provide the care that is needed, then assisted living, unable to stay independent, or if people, they don't have any of their own sibling, what do you call, kids or spouses, that is where it is assisted living. Then in case of serious illness where you are not able to take care of, like a complete paralysis or otherwise, is nursing home, wherein they do everything for you, basically cleaning, bathing, feeding, everything. That is why it is so expensive, because, and also it's a very, very tough job. I have seen firsthand and gone through that for 2.5 years and seen people who provide that kind of care. My respect for them have gone up immense, multiple fold. It's really, sometimes you get upset that your dear loved one is not getting you expect that he should get. But the kind of tough job that is, that's why there's a high rotation of people, employee turnover, but it's a tough job. Nursing home, that is a tough place. So if at all you have any time, or in fact, I encourage everybody to just go once, visit one of the nursing homes which is closer to you. It's not that you basically, it's a kind of an eye opener. So it will give you two things. One, what kind of environment, what kind of expense, and most importantly, it will give you a what do you call, clarity of picture, whether you want to get your own health care at home or at nursing home. So what are the options? You should be able to decide in advance, and also you can put it in your will. That is why it is needed. Hospices, of course, is end of the life care. Basically, people are given comfort of not knowing pain and all, so that they can pass away without feeling the pain in a very calm and quiet and peaceful way. Now, who pays for it? The payment can come from our own personal savings. We saw how much it costs. Today, it's about 150K in Bay Area. So you do the math of 6 times, that is today's dollars. When it is inflation, you know what it is. So we need to essentially budget or plan for it, at least that kind of, in today's dollars, about $1 million for about 6 years or so, depending on, we need to plan for that. Next, if we don't have personal, what do you call, wealth or whatever, Medicare people think will pay. Medicare unfortunately does not cover. Last week, 2 weeks back, and in fact last Thursday we covered that. Medicare does not cover long-term care. Medicare does not cover long-term care. It's like a mantra. It's like one has to repeat, because long-term care is one needing a continuous care because they're not able to take care of themselves. It can come from pure old age, it can come from accidents, it can from disease. Medicare, what covers is only first 100 days. This is what it covers. The first 3-night hospital stay, it won't, but after that, up to 100 days it covers. But after 20 days, there's a copay that one need to pay. But if somebody is in need of long-term care, just like my dad or anybody else, after 100 days for next 2.5, 3, 4, 5 years, it should come from your pocket. Unfortunately, that's the reality. Now, Medi-Cal or Medicaid. Medicaid is the federal government program for providing medical health, health care for absolutely poor people, people whose wealth net worth is less than 5,000 at a federal level. California has a little liberal up to $15,000. So Medi-Cal, government of California, has its own budget. It adds those budget dollars to the federal funds and then provides a much more comprehensive or much more extensive program compared to any other state in the United States. So that's why our taxes are a little higher. So that is first-hand Medi-Cal. But remember one thing, that is only for people who are poor, absolutely. So you should not be having any wealth whatsoever. So all your wealth should be spent down. People think that, okay, I can write all my wealth down to my kids or somebody else, and I will be totally declare myself as poor. They have a 5-year look back period. They can go back and look, and they can basically recover from your estate if there is any such hanky-panky. And government makes decision whether you are in need of and what kind of service you can get. It is not what your choice is at all. And then, of course, we are talking about long-term care insurance. It is one of the tools that is available for us, all the people who are here, who can plan ahead, think ahead, and put an action plan in place so that we take care of ourselves and our loved ones. Now, we saw that who are the people who are providing the care, right? This is skilled nursing home. Health home or home care aide or homemaker, people who come home and so these are the different kinds of healthcare providers that we have. More people are using long-term care service at home than in the facilities. Two reasons can be. Right now, it is because they can't afford. That is the reason. But if you plan well, then you will have the financial ability to get the same kind of nursing care at home, which is what you want. Most people may want that. And people are using longer service at home. One more study shows that when people get their service at home, they live longer and better compared to in a nursing home. Why? However skilled nursing home it is still a depressive place. It's not your family is there. It's a tough place. So that is why people live longer at home than in the nursing home. Now, the other kind of care provided, there are adult care facilities. These here, essentially people are able to take care of themselves by basic stuff, and they are given guidance, they are given reminders, they are served food, they are reminded about medicine and all that adult daycare. Now, this is what is absolutely a depressing sign of nursing care, nursing homes. Now, each one of them, they will be in their own room, but instead of being in the room, whenever it's possible, they are brought out and then there's what you call wheelchair or otherwise, because there's not many people talking or because their own condition, they are not able to talk. This is the sight which is very common, which you will see. Really tough scene to watch. Now, who else can provide the care? Your own, one's own family members. When family members are giving care, there's so much of stress because if that particular family member is forced to give the care by quitting the job or cutting the work hours, obviously there's a financial impact. And in addition to the tough nature of the job, you are also suffering financially. That can create a lot of stress. And what are the impacts? Family relationships can be damaged. Basically, you do that, you do this, I'm not responsible, I don't have the money, you're not pitching enough money, and the sheer amount of workload. So these are absolutely realities that there are financial impacts, there are physical and mental stress that is involved when providing for near and dear ones long-term care. So emotional stress, physical stress. Now this is a little lengthy, but it is worth reading out. So bear with me and pay attention. Long-term care does not happen to an individual. It happens to the entire family. Without a means to pay for help with caregiving, relationships can suffer irreparable harm. Marriages are strained to the breaking point when care of a patient or in-law, a parent or in-law becomes too much or lasts too long. Your parent, my parent, so I don't have money. It's a strain on the family. You can imagine the situation. Siblings relationships are damaged because the caregiving burden of a parent is not distributed equally and often falls mostly on one person. Here, I am too busy, and I'm not in near the, what do you call, in the same town. I don't have the means to support. You have the more money, you know where I'm going, right? All kinds of things can happen with kids, with children. So that is where it's important that we plan. By injecting a meaningful long-term care insurance policy into any one of the above situations, the stress level is significantly diffused and relationships are preserved as family members retain their respective roles instead of becoming primary caregivers. The son stays the son, the daughter stays the daughter. The healthy spouse or mom caring for an adult child gets enough rest, which works wonders to avoid depression and stimulate a positive outlook. Caregiving responsibilities will crush the dreams of millions of women in the next 10 to 20 years unless families plan ahead with long-term care insurance. It is proven statistically and quite evident that most of the caregiving falls on the women folk, whether it is be a daughter, whether it be wife or otherwise, whether it's the mom, which is a little rare unless the family really had an unfortunate situation, like the case of Lonnie in the next room of my dad in the nursing care. 40 years he was bedridden due to serious motorbike accident, paralyzed for life. But coming back to the lot of responsibility, stress falls on the females, women folk, and most of the time, wife, the age of wife is less than the man, husband's age. As a result, she is there taking care of the husband. But when husband passes away, there's nobody to take care of. It adds double burden financially, as well as there's nobody to take care of them unless you plan ahead, unless you are lucky enough to have stronger family and a family which is, kids who have the means to take care of. So that's where it's very important. Most of the times in the couples and families, which I do this educating and sharing the sessions and all, advising them. If the husband is getting all the salary, a paycheck home, they tend to discount the importance of insurance coverage for the wife. If you truly love your wife, and it's the same thing applies to women folk, it is not that you basically there's nobody else that you need to. If you love yourself and your family, you protect yourself and your spouse with enough of protection, so that when we are there or not, there is somebody else, there are means to take care of, provide that kind of care. Now, why people need to buy the life in long-term care? To protect our one's assets, income and lifestyle, and life savings. As again, one example I would like to say, provide here, even people with the good means. Last year, one particular family, this about $5 million net worth. Oh, we don't need long-term care, planning and all. Worst comes worst. Based on the numbers you are giving, it's about $1 million is the allocation. I'll allocate this. So my financial advisor said, not needed. We are good. Excellent. Very happy and proud that you have the means right now and you can allocate that. But did you look at this in a different angle? Did you do the math? Right now, based on your calculations, you are going to withdraw about 250K per annum for living expenses. Good. Then if should something go wrong, you need to withdraw an additional 150 to 200, depending on when it is, an additional amount of money to pay for the nursing care, the long-term care. So you are already withdrawing 200, say another this 150 or 200, 400. What happens to your tax bracket when you add up your Social Security and other stuff? You need to pay higher taxes. To pay that higher taxes, you need to withdraw an additional amount that again increases your tax bracket. So you know where I'm going. Instead of original calculation of paying taxes very minimally in your basic withdrawal, right now, based on this scenario, you'll be ending up paying much higher. Again, because you have good net worth, probably you'll be able to survive and do, but your nest egg, whatever wealth you built, may be exhausted. So isn't it prudent enough that you have the means to plan right now so that you can pass on this estate and wealth to your children, and you not necessarily put everything online. So thinking a different paradigm shift is needed to plan like that. Now, why else people need to buy long-term care? Protect the plans we have made, maintain the dignity. That's the most important thing. We should not be depending on generosity of others, and we should be able to care for ourselves. When there's money, the dignity is automatically can be protected. Maintain control over care. Government is not deciding whether it's long-term care or otherwise. It is you who decide where you want to get, whether in nursing home facility or at home. So that is where it is important that we have the means to control our own destiny. Don't want to be a burden to the family. Very, very important, whether it is be your siblings, whether it's kids, children, or spouse, or anybody else. You do not want to become a burden financially to somebody else because we failed to do our part when we had time to do that. Now, protect assets, income, and protects lifestyle. Then again, so what are some of the most important reasons why we need to do the long-term care planning? 65% of people do not have to be a burden to the family. I do not want to be a burden to the family. That's why 65% respondents, why I need to do the planning. And 51%, I should be able to afford quality care in the setting I choose, whether at home or at the nursing home or whatever the choice. I want to decide. That's why I want to do the planning and keep it in place. Then 48% said to protect my spouse or loved ones, quality of life, and for future security. They should not be worried about how to provide care and also doing the back breaking. By the way, one person is not enough to provide care for one adult. At least two people giving, whether it's cleaning up, giving bath, or feeding and all, two people are needed. It's not easy. So that's where we do need to have the planning. And of course, finally, people said, 23% said to protect my assets so that I would like to give it to my kids or legacy to the children. The number one retirement worry of uninsured medical expenses. 39% medical expenses not covered by the insurance. That is the fact. Living longer than I expected by outliving my money. This is one of the most important worries that people have right now. And of course, lack of social security, which will be there some kind, some form. It is not easy to get rid of it, especially when the fate of the people who are being elected is in the hands of most of the senior citizens. It won't go away that easily. It will be, only thing is they will be keep pushing the retirement limit from 62 to 65 to 67 to 70, whatever. But it will be there. But we need to plan for the decrease in the benefit. That's again, we had that session 2 weeks back. And 4% said lack of company pension. Now company pensions, it's absolutely they vanished. Government and very, very few companies which you can count on fingers are providing pensions. Now what are the different payout options? Reimbursement. What is reimbursement? If we have a policy, if we have some kind of a protection, and if the policy says it's a reimbursement, we should be very careful, because reimbursement means an expense is incurred and you submit the bill to the insurance company. That is what a reimbursement is. Indemnity. Indemnity means they say they pay X amount of dollars, they pay. It doesn't matter whether you incur that expense or not. It can be for a family member who is taking care of, who is providing the care. Then cash benefit is equal to that. Example, in case of $200 per day and $6,000 per month benefit, actual expenses 180. What kind of benefit it is? In case of reimbursement, you get only $180. In case of indemnity, you get $200. So the total amount, even though the So you don't need to worry about submitting the bills and then some of them being, okay, this particular lotion is not needed, this particular thing is not needed. That kind of problem is there with reimbursement. Now, we are almost coming to the end. What are the different types of programs that are there for long-term care? Standalone long-term care policies. Just about a couple of, I think 6 months back or so, my wife works for Oracle. They, after a long time, they did come out in their benefits program, a tie-up with the Genworth, I think, a exclusive, pure long-term care solution. Unfortunately, it is not cheap, and the benefits are not great, especially when you are mid already 50s into the it becomes very expensive. So, and also the challenge is whether you use it or lose it. You keep paying it, and if you don't need, by God's grace, if you don't need long-term care, whatever it is, protection, you lost it. Basically, you paid for the safety part of it. Which is not bad in its sense. Most of the car insurance, home insurance, we buy what? Fire insurance. Do we want to use that fire insurance? No, we don't. It's a peace of mind. So in a way that is needed, but it's a little bit expensive. Then there comes a long-term care rider. Most of the universal life, variable universal life, index universal life, these are the vehicles, these are insurance policies that are available on which you can add a long-term care rider. When you add long-term care rider, insurance companies do charge a bit of additional cost or premium on that. And then rest of it, it continues to grow the way it is promised. The key here is the younger you are, the healthier you are, the best rate it is that you get, because insurance companies are what? They are risk managing. They are taking your risk to at a certain cost. If the risk is good, then they charge you pennies. If the risk is bad, like in the insurance company says, I'm trying to get coverage for an additional a million plus because when the coverage I took long time back is coming to an end in the next 3-4 years. I'm 18 years older than the last time when I took that term coverage, and one liver enzyme is higher. Every other metric is fantastic, but insurance companies says that your risk profile is different and it's going to cost you. So younger and healthier, the keys, two keys, the better it is. Your cost will be absolutely very, very minimal, and whatever money you are contributing will explode with the good returns. So LTC rider on those policies. Then you have linked benefit program. Insurance companies have come up with the newer solutions wherein you have an asset, whether it is in terms of an annuity or otherwise you have money. People who are nearing retirement are keeping certain amount of money in the liquid funds, cash accounts, sitting in the checking account, or your money market account, because you need that rainy day fund of 100, 200K. Insurance companies have come up with a solution saying, instead of parking it in the bank where you are not getting anything, you park with us. We'll give multiple times of death benefit, and most importantly, a very, very high compounded growth rate, long-term care. And incidentally, you change your mind anytime, we are going to refund your entire premium. So triple benefit, no loss whatsoever. Unless you cancel in the first 1 or 2 years, they have some 15 to 10, 12% of penalty, depending on which company. Some companies don't have that, but their growth rate, which they give long-term care, is a little different. Bottom line, what I'm trying to say is there are solutions to suit each and everybody's individual needs and how you tailor it. The question is whether we take time to do that. Annuity with LTC rider, which I talked about already. Now, tax benefit. Remember, government has given a tax benefit break if you are covering yourself against the long-term care. And that is, anything above 7.5% of your gross income, automatically you see that you can account as expense. And also long-term care as such, and the premium is eligible for tax deduction. 28 states have tax incentives for individuals. Use HSA for long-term care insurance. HSA is again one of the powerful ways to plan for future health care. Very, very powerful. If you're not doing that, you should. So some of the bands basically, insurance policy with LTC rider. This I already covered it, but some of the other points. Life insurance, you don't have to die to use. A long-term care rider accelerates death benefit for healthcare benefit. What does that mean? Whatever the face value, whatever the value that of the policy that is there, which keeps growing, it is automatically equal to death benefit is equal, and long-term care benefit is given along. Again, depends some insurance to insurance company. So to a certain extent of 1.8 million or so in case of Transamerica, about nationwide face value which you start is the long-term care. So bottom line is that what do you call death benefit is available for long-term care health benefit as well. Long-term care benefits available, how much it is paid is, again, there are certain calculations. 2% of LTC specified, if it is $1 million, 2% is what? So 20,000, right? So, or there is certain per diem defined by the HIPAA, so they will take those benefits and calculate what is the maximum benefit that is available. But as long as the money is there in your account, they keep paying that. Examples, there are a couple of examples which individually varies. Why should you consider long-term care? Why one should wait? Why are we doing this? One is most important, knowledge, awareness. There is such thing called a long-term care scenario which can exacerbate our retirement planning. So we need to be aware of it. Is right now that is a exercise. Once we are aware that, what do we do about it? That is what we are. You are never too young to need a long-term care services. I told about the guy, Lonnie, who met with a motorcycle accident and ended up in a long-term care scenario. Depending on the way it is, he'll be there for a long time. It may never be more affordable as LTC insurance premiums are continuing to rise. Unfortunately, the fact of the matter is hospital costs, nursing home charges, and healthcare costs in general are rising much faster than any other expense item, any other costs. So the costs are just going to go up. They're not going to come down. The interesting thing about that is long-term care costs are going up, long-term care insurance is going up, but life insurance, because of the longevity that is going up over a period of time, those costs have come down, term life costs. That's an interesting, what do you call, information. If your health changes, you may be unable to qualify. That is a fact of the matter. If something goes wrong, it's suddenly some system, some issue develops. You have some, whether it is sugar, cholesterol, or anything. We visit an ER a couple of times. We will not be able to get the long-term care protection because at that point in time, it is not an unknown entity. It's a given. So insurance company, they don't want that risk. Life insurance plus long-term care rider. What are the pros? Higher cash value and higher death benefit, cash indemnity payout for long-term care. And what are the cons? Sometimes lower long-term care benefit compared to the death benefit, and very strict underwriting. They want the best risk possible. If the risk is not good, the rates are going to be higher. And hello?
Go ahead. Sorry, it was my computer.
Okay. And a longer surrender period. Okay, this is a couple of examples, so we don't need to go through this. Essentially, it's one of the companies. What there are different solutions that are available. Now, true dollar to long-term care, how to qualify? We already covered this. So 2 out of 6 activities for daily living, which bathing, continence, dressing, eating, toileting, transferring, these are the usual. Benefit amount, full amount of the death benefit, dollar to dollar for LTC. Example, 500K death benefit qualifies for 500K LTC. Again, there are subtle variations from company to company. For example, nationwide, it fixes whatever is the initial starting value, even though your policy value is growing, They peg the long-term care at the initial start amount, whereas Transamerica gives whatever the growth amount to certain amount, I think it's 1.8 or 1.5 million. And there are individual companies, subtle variations are there, but this is at a higher level, this is what it is. Benefits paid 2% per month or HIPAA per diem, which again, I said, if it's $1 million face value or the policy value that you have, your cash accumulated value, then 2% per month, 20,000 is what the cost of long-term care one can hope to get if the HIPAA per diem based on whatever the government has declared. Either of them, whichever is higher, they give. Now, index universal life plus long-term care. This very powerful instrument, powerful vehicle, which we talked about a couple of times. And this is essentially a vehicle designed for absolutely rich people. Yes, I mean rich people. Why do I say that? You know that I know that what we are saving money in 401ks and Roths and all that, they're essentially 401ks you're postponing, and then whatever wealth we are building, we are expected to pay taxes. Roth, most of the people are not, they're not eligible because they make too much money. Now, the lobbyists have lobbied for, and then they said, okay, there needs to be a certain kind of retirement benefit where whatever wealth I'm growing is exempt from tax. So the industry came up with this index universal life, and it is under IRS code 7702. Basically what it says is any amount that you are contributing is your post-tax dollars. So whatever growth you have there is 100% tax exempt. Roth is the same, post-tax dollars, but you are not eligible to contribute if your AJA grows above 150K. Whereas here there's no such limit. What is the beauty? What is the link? There should be some catch. The catch, they said, is as long as there's a certain kind of linkage to the valuation of your life. So you need to take life protection to certain, and then over and above certain multiple will be allowing you to build without any tax component. If you fund too much of it, then they'll say that this particular policy becomes what is a modified endowment contract, wherein you will have to pay taxes just like your brokerage accounts and all. So the system cautions you that you're putting too much money, or there is a way to find out. But otherwise, so if I'm a wealthy person, I can take $1 million, 2 million, 10 million, 20 million, 100 million. There was a Chinese investor last year who took 100 million worth of IUL. So then the multiple of that you can contribute, and that keeps growing whatever the returns are, whether it is 7, 8, 10, up to 15%. Entire amount is 100% tax exempt. And when it passes to your next generation, there is no estate tax on that. That is the beauty of it. So what are the things that it gives? People call this the Swiss Army knife of financial instruments. Death, terminal illness, true long-term care, and residual death benefit once if you use up the money and all. Cash value, tax advantage, downside protection. When the market goes down, whatever the valuation in the policy is 100% protected. When the market goes up, they give you up to certain extent, 15%. If market gives 30%, you don't get 30%, you get up to 15%. But if the market goes down even 5% or 50%, you are protected 100%. That's advantage. Flexible funding. It is not necessary that you have to pay X amount it is flexible. Sometimes you can pay very less. Sometimes when you have the ability, you can pay as much as the policy allows without making it a modified endowment contract. Now, there are different examples of this long-term care, which I said is essentially for senior people who are, they cannot grow the wealth in the IUL, but they want the long-term care. So insurance company, that triple benefit, remember I said, this is what it is. So you are giving 100,000 as a premium, and then they are giving a long-term care, they are giving some death benefit, and depending on the number of years, depending on the compounding option you choose, it can be a very attractive proposition. Why should you consider LTC now? You are never too young to need long-term care, which we saw, and it may never be more affordable as LTC insurance premiums continues to rise. If health changes, we may be unable to qualify, which we saw this previously. Apply for long-term care insurance. 17% of applicants aged 50 to 59 were denied long-term care because of the health issues. 17% from 50 to 59. 45% of people were denied coverage once they hit 70 years. So when you talk about this, ensure that you talk to somebody whom you can trust, somebody who can who have multiple access to multiple A+ rated companies, and also that they can give you proper right solution that is needed. Essentially, this is a conversation starter. Make this conversation with your better half, with your kids, or with your parents. It is worth having that dialogue, so that in the entire pie chart of financial planning, this is one critical element. If we do not cover this, then there is that. Who knows if in the journey we may just land on that particular dangerous what do you call pit or ticking time bomb. What's right now for you? Age, health condition, income, assets, location, and take action now. Now, we are doing this multiple sessions, basically financial classes, business classes, and all. And back to the first slide. Again, having a comprehensive plan means not just doing your 401k, not just working 9 to 5 or 9 to 9, 12 hours. It is covering all the bases. That is the purpose of this series of lectures that we are, webinars that we are doing. We need to cover all the areas. It is not enough that we have a good 401k. It is not enough if we have just a brokerage account doing good trading because the market is doing so well. And it is not even good enough if you have 1 or 2 rental properties. Tomorrow, what if 2008 repeats all over again with high leverage and all? Who knows? It is essentially distribution of risk. It is essentially covering different segments so that we are not dependent on any one segment. Remember, in retirement, our absolute mandated needs are met with guaranteed income. That is the the purpose of this. And we eliminate as far as possible any of these ditches, any of these pitfalls or these ticking time bombs. We diffuse them in advance. So that is the purpose. So next week we also have a different session, that is passive income investment. That is September 3rd, 8 p.m. to 9:30 p.m. Pacific Standard Time. With that, I come to the end of today's session, 1 hour exactly, I think. And now I open the session for any questions. It's a very, very sensitive topic. It's a serious topic. It is something which we have to, all of us have to pay attention to. Without any questions, because we are living here, it's going to be an expensive affair. And medical field advancements will make us live longer. That means the costs are going to be there, significantly higher costs. So we need to cover ourselves. Any questions? Let's.
I have a couple of questions here.
Okay.
So you briefly talked about taxes. So just want to, can you elaborate a little bit more upon tax issues? Are there any tax issues with long-term care insurance similar to disability insurance?
I am not sure what the question is. What is a very when you say tax issues, means you are talking about whether the money that you are contributing is from the tax exemption you're talking, or the money that is growing to grow in the policy, how it is exempt from the tax. Can you be a little more elaborate in your question? Where is the question that is? Is it in YouTube? Or I'm not seeing here.
No, it's not there. So the money that is growing and the money that you would be receiving as a benefit when you are claiming the long-term care.
Okay.
Are there any taxes? Will there be any taxes?
Okay, that is the beauty of it. Long-term care, any amount of money that is you are putting in, there are different kinds of insurance we talked about, right? One is pure long-term care, There's no question of anybody paying any taxes. If there is a need, and if you're identified, qualified by the doctors who is saying that you are in need, insurance company will pay pure long-term care insurance. And then second one is this linked, the long-term care rider, whether it is with IUL, VUL, or any of that, then that is where the money that you are contributing on a month-to-month basis or a lump sum amount, whatever, it is expected to grow at certain rate based on how the market performs, based on what choices you make within the policy. Assuming you have started a policy, 500K today at a 40-year-old, by the time you are 65, maybe it is about 1.1 million or whatever, the death benefit, and the cash value may be about $1 million or 900K. You don't need anything from it. You don't touch anything. By the time you are 70, it grows to 1.4 million death benefit. The cash value grows to say about 1.1 million. There's a difference a little bit between the cash value and the death benefit. After certain time, they catch up. The cash value, if it is growing fast enough, it catches up. Now, whatever that is grown in that is tax exempt or tax advantaged. How do they do technically? This is how they do. If there is a need, then you can withdraw without giving any excuse, any reason from that cash value, or when you are qualified for a medical long-term care facility, that death benefit of 1.5, 2% is 30,000 is what is qualified. There's no tax component there whatsoever. So if you are withdrawing from the cash value, whatever you withdraw, initial contribution is, they call it as a withdrawal of your own contribution, so there's no tax on that. Then, for example, out of 1.5 million, your contribution was, say, 450,000. For up to 450,000, they're going to say that as withdrawal of your own money contribution. Once that is over, the additional money you are going to withdraw, they're going to say it as loan against your policy. This is a technicality of accounting. They want to put it as, you don't need to pay any tax on that because you're taking it as a loan with an assumption over after some time period and all, you can pay it back. There are situations where a person would like to pay it back. Say, for example, I have multiple cases where after about 60, 70, they have these multiple rental properties where they're not able to manage, they sell it, and then they dump the entire money into long-term care IUL policy. Why do they do that? They have taken earlier loans on that, and also they're adding here. Why? They already paid their taxes on that, and whatever they want to grow on with the whatever amount available, they don't want to pay any more taxes because that is tax exempt once it is a life benefit once you pass away. So bottom line, long story short, there is no tax component that we need to worry about.
Okay. So the second question is, what about the pre-existing conditions? Do I have to worry about pre-existing conditions when I buy the insurance or when I get the benefits, when I'm receiving benefits?
Okay, the pre-existing conditions, it will definitely have an impact, or insurance companies will decide based on, but again, what kind of pre-existing conditions, right? If I have borderline blood sugar, or if I have borderline hypertension, they have this various categories they call elite category, super plus category, and standard plus, and standard, substandard, and then on the substandard they do the rating, what do you call, 25% table A, table B 50%, table C 75%, table D 100%, table E 125%, table F 175% extra loading of the premium. So they have a way of getting their money worth from the point of underwriting the risk. A lot of people, there is a challenge here. One is insurability itself. If I'm in a super good condition, that's where I need to take action when I'm healthy and when I'm relatively young. But whatever happened, we didn't take action. Right now I'm 45 or 50, say for example, 55. Right now, take my own example. I was smart enough to take outside insurance, 1.8 million, when Verizon and City of San Francisco were giving me at workplace 1.8 million, 3.6 million. But I was not that smart enough 17 years back to take a 30-year or 35-year coverage. I took only 20 years. I pinched there. Why did I? It's a human nature. So right now, when I'm looking to take an additional coverage, they're charging for the same $1 million where I'm paying currently $800 per annum on a $1 million policy, which I took about 17 years back. Now, if I want for next 30 years, they're charging 9,800. So it's a dilemma, right? Whether I take 90 years, 30 years, 20 years, 15 years, or go for what do you call whole life policies. If I don't, it's costly because I'm older in age and they're not giving me preferred rating, they're giving me standard rating. The dilemma is, do I go without coverage and hope nothing will happen? What if tomorrow something goes wrong, and what about my obligations to my family? So that is where it's imperative that we take action today. Even if we are late, we still have to take action. So if your condition is not, let the insurance company decide how much they want, what kind of rating they want to give you.
Okay, that's all I have.
All right. That is, you were asking from YouTube, or because I don't see any chats. All of you who are present here, you are not able to ask any questions. You can type your question in chat or Q&A. There is no bad question. Please feel free to ask. Okay, one question. If we use LTC benefit, does cash value and death benefit go down too? Do we need to additional contribution to maintain policy? Okay, so whenever there's a money outgo from the policy by way of withdrawal, because we want to withdraw money for our living expenses or whatever, you don't need to give a reason, or for the long-term care benefit, anytime you take the policy money out, obviously the balance that is there, cash value, that is what is generating the additional revenue, right? So it automatically keeps going down. So when that it keeps going down, it impacts your overall coverage as well. Why do they do that? Say, for example, you are at 1.5 million coverage of life and what do you call LTC and death benefit. Your cash value is say at about 800,000. If you start withdrawing, or for some benefit for this, start withdrawing about 20,000 or 15,000 for the LTC benefit or otherwise, your cash value is reducing. If you don't adjust the long death benefit or the long-term care benefit, 1.5 to lower adjusting, the cost that is needed, the premium that is needed to sustain that high value is much higher. So your depletion of cash value will be much faster. Thereby the policy will, what do you call, lapse much sooner. So there has to be some adjustment. In fact, it is recommended that based on the withdrawal, you tweak that. You can even ask individual reduction on the death benefit by 10, 15% or 20% if the cash value is depleting faster.
Okay, so I have one more question in the UK. What type of assurance do we have if one of these financial insurance provider bankrupts?
That is a fantastic question, and that is my favorite question, because all of us, we are worried about the financial strength of, but I want to give you two examples here, two rather, what do you call, reasonings or explanations. First and foremost, what is insurance? Insurance is essentially offshoring your risk to someone else. Majority of the people pay very minor amounts so that any individual needing any higher amount in a compensation is provided. Right now, for example, I take $1 million policy, paying a monthly, if a 30-year-old pays about $40, and should something go wrong, the insurance company is paying $1 million for $40. How do they do it? So large amount of number of people collecting it. But what is individual is doing? Individual is transferring their risk to insurance companies. Insurance companies are professional entities. What do? They offshore their risk to somebody else. That is called reinsurance. It is not at the will. Actually, it is mandated that insurance companies, offshore based on their financial strength, based on their books. Anywhere from 80 to 90% of it is offshore. The only thing is when we are paying insurance premium, entire thing goes to the insurance company, and these insurance companies in turn keeps 20% of their portfolio in their books, and the entire portfolio is offshored onto into the reinsurance market, whether it is Lloyd's, London, or New York or Tokyo reinsurance markets. So that is how they protect. It is exactly the way stock market you do your protection, all the financial institutions, right? Second, we are that one more precaution we need to do is deal with only the A+ rated, very long mature companies. That the companies which you have seen here are all the A+ rated companies. Okay, so these are all 100 years plus A+ rated companies. So whomever you are talking to, ensure that you get some of the best, biggest companies. There are absolutely very negligible cases of insurance companies going bankrupt, especially when they are these A+ big companies. And in 2008, for example, 145 banks. Are you stopped investing in saving money in banks, putting money in bank? FDIC is insuring only 100,000. They increased it to 250 after that. But bottom line is 140 plus banks were allowed to go bankrupt. Only one insurance company faced the situation and government rescued it. That was AIG. So bottom line, strong big companies, insurance companies, they do reinsurance. And so what is the danger of somebody going bankrupt? I would say very, very remote, but can I give it in writing, or can anybody? So tomorrow there's some kind of a huge wave of COVID continuing, all these people who are insured, they die in large numbers. Insurance companies can be stretched. That scenario can happen. Nobody visualized COVID happening, right? But those are the outlier scenarios. Any other questions?
So I have.
1 second. I think there is some question. Okay, this is answered. Okay, all of you who are attending, once again, thanks a lot. Hope these sessions are meaningful, useful. Please do drop a line. You can send an email, or you can a text. You can do any number of ways of communicating. This is my information. Feel free to contact either on my email, azad.aramandla@gmail.com, or my phone numbers, or you can even see my website, advisorazad.com. And if you have any requirement for a personalized financial strategy session, please feel free to go ahead and schedule a session. It's a 2-hour financial health check. Every year we do once a year health check. If we are not doing, we should do that. But not even in 5 years, 10 years, we do a financial health check. We do have to do that. It's absolutely 100% a complimentary session. It will show you what your current status is and where you are going with the way you are going, and whether you will meet your targets, and what are the landmines that are there. What we do the trend analysis into the future and see whether the income that you're going to generate will be sufficient to cover your expenses anticipated in the retirement, and what are the pitfalls that are. If somebody has shown this to me 20 years back, probably I would have done things a little different for my kids and myself, right? So you have the opportunity, and please make use of that. I promise you 100%. that I will not be selling anything directly unless you find a need and unless you want to do something about it. It's a purely complimentary session. Thank you.
Okay, so thank you very much.
Oh, one second. Somebody has last minute's question. How much it costs to cover completely long-term care or disability? What are the different options and their costs? If we already have IUL, VUL, if haven't already, can we add it now? If we already have, okay, so you have a policy, but you don't have a long-term care rider. That is what I guess your question is. So normally those policies have to be applied afresh and underwritten afresh. And how much it costs? When people ask this question, when I give this answer, it sounds a little, escapist answer. It is not actually. Unfortunately, insurance is all individual, personal. It depends on age, whether we are male or female, where we live, what kind of health we are maintaining, including our height, weight, body check, mass, all these things define. So the same person, at the same age, one person can get absolutely the best rating and one person be absolutely not qualified at all because his A1C levels are at 7. I had 3-4 cases, unfortunately, of in the last 6 months, very young, 35, 38 year olds, they got rejected because they were not aware that their A1C levels are at 7+. Very engaged insurance companies don't like that. So how much it costs depends individually on yours. And again, between companies, there can be slight variations, but mostly they all have certain guidelines.
Okay, so I think this is the 8th session that we had on this financial planning. The next 2 sessions are going to be on the investment. That will culminate our financial planning classes. So please attend the next session. It is all about passive income investments. It will be held on next Thursday at the same time.
Yep. Class number 9, passive income investment. That is next Thursday at 8 p.m. Pacific Standard Time. Leela will be covering that. And we would love to see you all again. Once again, please do send your remarks, your recommendations, or any topic that you that we might have missed, or any specific question, anything. We'd love to have some feedback from you. Thank you. And thanks a lot for taking time. Have a great night.